The hell is that?
The Dow's latest surge higher has put the stocks index within 3% of setting a new high for the year. So it's not looking like it's going well for the stocks bears, but at least into early February we're proclaiming that the great bear market apocalypse was upon us. Instead, for the past couple of weeks or so, have been increasingly going into hibernation. Though I have to give it to the perma bears, though I've been wrong for the longest, are still out there pumping out bear market crash rhetoric of 30%, 40%, even over 50% drops in price. The problem is that the bears still don't understand what I voiced right at the beginning of the stock stealth bull market in March 2009 and several hundred times since, that the markets are manipulated. Every stock price is manipulated, and they still don't get this fundamental fact and its consequences in terms of driving multi-year trends, but instead bang on about this, that or the other for why the rally must always end. Just keep banging their heads against a brick wall. And remember, this is what I've been stating for the 7-year duration of the stocks bull market. So not something obvious with the benefit of hindsight, as several recently are stating, all after the fact, after stocks have been rising for many years, that it's all due to Fed market manipulation, but then ad must imminently end. Well, the Fed and the other central banks have been manipulating stock markets since at least October 1987, the day after the great crash when the Dow bounced. Now, whilst I've yet to get around to the usual thorough in-depth stock market analysis that tends to conclude in a near year-long trend forecast, for the primary reason that my attention for the past month or so has been diverted by Britain's very last chance to gain freedom from the emerging European superstate, that is the EU referendum, a campaign that currently has the Leave EU camp at a disadvantage, both in terms of opinion poll standings, i.e. 45% against 55% to remain, and in terms of the establishment stacked against the Brexiters, which I'll come back to towards the end of this video. Nevertheless, my series of interim stock market posts and videos have been unequivocally consistent in the following 2 points: that the stock market was undergoing a severe correction that would result in a resumption of the stocks bull market, and that the stock market was expected to track the crude oil price trend forecast, which called for an early February low at approximately $25. So once more, the starting point for this interim analysis of the stock market is where the crude oil price stands against the trend forecast for 2016. It's now over 6 weeks since I published my forecast expectations for the crude oil price to bottom early February 2016 at approximately $25. The actual bottom came in at $26, and within the time window for a final bear market bottom, as the video illustrates. The overall picture being painted by this analysis is expectations for 3 trading ranges that would act to step the crude oil price higher during 2016. For instance, the current bottoming range, followed by a second retesting range, and then the third breakout range. Therefore, my forecast conclusion is for the crude oil price to trade within 3 distinct trading ranges for 2016 of $20 to $40, $35 to $50, and $62 to $40. Furthermore, the trend pattern imposed onto the trading ranges implies that a bottom is likely by early February 2016 at around $25, followed by a trend higher into mid-year towards $50, correction into September, and then followed by a trend towards $62 before succumbing to a correction during December to target an end-year price of approximately $48, as illustrated by the graph. The bottom line is that the current oil price collapse is a wake-up call to all major oil producers that crude oil as an energy source is running out of time. So whilst there may be future oil price spikes, however, the long-term trend, given the likes of climate change, is for the oil age to go the same way as the previous ages, such as the Stone Age and the Bronze Age and the Iron Age. So it will be for the oil age, which means nations such as Saudi Arabia, regardless of price, understand that they need to get as much as their oil out of the ground as possible and sold off before they run out of customers. The crude oil price last close of $1.34 stands about $8 higher than its recent multi-year bear market low of $1.26. Whilst little has changed fundamentally so far in terms of supply, OPEC and the others are still pumping flat out and Iran continues to ramp up production. Nevertheless, demand destruction of many smaller oil producers operating at below break-even prices is finally starting to be discounted by the market. From a technical perspective, the crude oil price is yet to make a significant higher high or bottom, which probably means that the crude oil price is likely going to hug resistance along $34 to $35 for some weeks before breaking higher. However, overall the crude oil price is showing little deviation from the trend forecast thus far, so remains on track to target a doubling off of its $26 low and therefore a trend towards at least $52 before the end of this year. And what jumps out from a quick technical take of the stock market is that the Dow has bounced 3 times off the August low, recently putting in a double bottom that's propelled stocks higher to the last close. A measuring move that appears just about done and therefore targets a correction to probably between Dow's 16,250 and 16,000 as being the immediate term prospects for the Dow over the next week or two. Whilst the MACD has turned positive, which overall favours a bullish trend higher. Overall, the impression is that the Dow, having bottomed, is now sowing the seeds for a sustained bull run that blasts the Dow through overhead resistance to over 18,000, the timing of which is likely to follow a higher low off of an imminent correction. So what does the crude oil price say for the stock market going forward, now that bottoms are in for both? Well, prospects for a tough few weeks for the crude oil price are likely to translate into a tough few weeks for stocks as well. So a week or so from now, the Dow is likely to be lower than higher, but not by much, as likely will be coming out of a correction, after which stocks should track the crude oil price rally higher. In terms of trend, well, the Dow chart clearly demonstrates that the Dow tends to outperform oil to the upside. Whilst the oil price has yet to breach its last swing high, the Dow has already done so, which, given the prospects for the oil price doubling from $26 to 56, then I cannot see why this should not translate into the Dow significantly breaching its all-time trading high of 18,351, which I'll cover exactly how high the Dow could go in a forthcoming more in-depth analysis. The bottom line is that the perma crowd will continue to see every dip as the start of a new bear market and thus be found banging their heads against the manipulated market's brick wall all the way to new Dow all-time highs. And briefly, the FTSE. Well, despite the fact the FTSE has just turned positive for the year, the Dow is yet to do so. Usually the FTSE tends to marginally underperform compared against the Dow. However, overall, the Dow and FTSE do tend to trend pretty closely together, and to date the FTSE is not showing any significant deviation despite all of the fear headlines in the mainstream establishment press of a litany of disasters that await an independent and free UK that are just not being reflected by the stock market, that is implying the opposite. Therefore, along with the Dow and the FTSE, should also target a new all-time high this year, which I'm sure the gullible mainstream press will report as being as a consequence of the EU referendum result. And where the EU referendum is concerned, then my opinion remains that this is Britain's very last chance to vote for freedom from an emerging European socialist superstate, as the following two recent videos illustrate why, that you can click on to watch right now. And lastly, do ensure you're subscribed to this YouTube channel for my forthcoming in-depth analysis and detailed trend forecast.